Kia ora and welcome to Share Lunch, brought to you by Sharesies. I'm Helen Mattison. Today we bring you part 2 of our episode on what investors need to know for 2026. In our first episode, we focused on share markets and the economic recovery in New Zealand. We now turn to the housing market, the popularity of shares versus property, crypto within a portfolio, and what effect might the election have on our economic outlook. For expert opinion and predictions, I'm joined by Craig's Investment Director, Mark Lister, and Kiwibank Chief Economist, Jarrod Kerr. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Jarrod, let's look at the mortgage merry-go-round. At the end of last year, it seemed to me anyway that quite a lot of people were switching, which we haven't seen so much in New Zealand anyway, and cashbacks seem to be the reason why. Are we seeing a different level playing field, if you like, in terms of banks and competition, and actually people actually think it's not so hard to shift? I will.
Yeah, potentially. I mean, cashbacks have been around for a while, but I think we've been a bit more aggressive on the actual amount you can get. Don't quote me, but I think you can get up to like 1% of your mortgage, right, which is quite significant for a lot of people and worth having a look at. We'll keep you for 4 years though, but they are definitely a part of the marketing strategy. I think appetite from banks has been quite volatile in recent years. So, this post-COVID period, like we obviously had to help out a whole lot of businesses and households over that period, and it took a long while for them to get their balance sheets back in order. But just in the last couple of years, we've noticed the big banks, their appetite for mortgages and business lending had dropped off a cliff. And the RBNZ survey showed that it's been negative, like collectively across the big four banks, for a couple of years. And at Kiwibank sort of make hay while the sun shines, sort of thing. So we've grown at an extraordinary rate in the last couple of years. And I thought, well, from an economist point of view, that's a nice story for Kiwibank. No. That's a macroeconomic shock. When the appetite contracts like that, that's a macroeconomic shock that exacerbates the recession. Now, the good news, over the last 6 months, all banks are back, all of them, and fired up. And we've seen a lot of competition from the big four across just about everything that we do. So mortgage brokers were telling me a year ago that, hey, look, I'm bringing clients and it's basically you and BNZ and no one else. And I was hearing that from our business bankers as well, and I thought that's extraordinary. Now, the same broker, all five.
So was that to do with the Aussies thinking, forget about New Zealand, it's in recession?
No, I don't think Aussies. I think it was banks just wanting to, this is bad, and maybe there was a few boffins in the back that call themselves, risk managers, saying, no, we better cool the jets a little bit. Precisely the wrong moment to do that from your client's point of view. Made everything worse. But, I mean, the RBNZ survey's data's there. It just shows it very clearly that, bank appetite was negative for 2 years. So that for me is a massive shock.
Yeah.
And sitting here now, I'm a lot more comfortable in our forecast for a recovery this year, based on the fact that the banks are back.
Okay, what about house prices? It's everybody's.
Yeah, well, we write a few mortgages. So we've got a little bit of an interest in the housing market. Gone nowhere for the last couple of years.
No.
And that's by design from the regulators and the central bank. Right, we had this extraordinary period coming out of COVID. We all put a higher value on our homes, and when you get a mortgage rate at 2%, well, off it goes. Let's not let that happen again. Okay, so basically the housing market's been walloped with interest rate rises, a whole bunch of things coming through, triple CFA, which is probably the worst of the lot, really changing the playing field. And then, we wake up now and house prices have effectively gone nowhere. You would have expected a little bit of recovery by now. Hasn't happened.
Yeah.
Green shoots just tend to die away. But again, we've finally got interest rates, mortgage rates at levels that actually entice people. So I quite regularly stand up in front of, property investors, and I'm like, why aren't you doing anything? And they're like, the mortgage rate's 7.5%.
Yeah.
Mortgage rate's 5.5%. Oh, mortgage rate's in the low fours. So a real difference in psychology when your mortgage rate is getting closer to your rental yield.
Yeah.
And we're getting there now. So I do think that this time the confidence that has been lifted actually feeds into activity. Plus, we're seeing it as a bank. We're actually seeing a little bit more.
So it's the investors actually.
Investors have been
making some money for once, rather than all the rates and everything else that erodes any.
Oh, there was a lot of that. But if we look at our lending to first home buyers over the last 3 years has been higher than investors.
Yeah.
Now, first home buyers, that bigger pool. Investors are this bigger pool, and then you've got owner occupiers, which are the rest. But for first home buyers to be doing more lending than investors is just, that goes back to that economic shock that I was mentioning around bank appetite. So now I think the investors have been the missing piece of the puzzle. As they come back in, the market will recover. We think 2 to 3% this year, which is not shooting the lights out, but at least it's a recovery.
Yeah.
And then probably 5% next year, thanks to interest rates remaining low for that period.
Do you think we're at a point where other investments like shares or bonds or whatever it might be, crypto, that Kiwi are actually thinking more about those other things than just property? Because, Bernard Hickey coined the phrase probably 20 years ago that the economy is a housing market with bits tacked on. Do you think we're actually shifting that? Because we've talked about it a lot on this program, but it doesn't seem to have gone anywhere.
Well, I still get a giggle every time I mention this in one of my presentations. I say, look, there is only one asset. And they all joke and like, yeah, it's property. Let's talk about it, And I say we've all got a little Sharesies account on the side, but it's probably 1% of our wealth, right? So people will laugh at that, but it's true. We as our balance sheet, is very much housing. Same with Australia and other parts, but in the United States, for example, they've got a much larger slice of their pie allocated into the fun stuff that you do, which is the stock markets and bonds and all that other stuff. We are very kind of one-dimensional in that space, and I think it's sad because I believe New Zealand's financial markets would have matured a lot faster had we had a more diversified portfolio as a nation. But I look at my father as a classic example. He owned shares in 1986. All of a sudden didn't own shares in 1987. Never bought another share in his life.
Yeah, put on.
He's still alive. So I think that's a classic example. Had we somehow gotten more money into our stock market, from my point of view, into bond markets, made more money available for small to medium, businesses, we would have a much better functioning economy. And I think your job would be even more fun than it is.
It's already pretty fun, Jarrod.
Yeah.
I've got the funnest job in the world, in my opinion. I think that's changing big time.
Do you?
I think Jarrod's right. The 87 crash. Remember, New Zealand got hit much harder than everywhere else in the 87 crash for a whole range of reasons. Our share market took 10 years to get back to those levels. It fell harder, fell about 60%, and then it didn't get back to those 87 levels until about 97, whereas the US and other parts of the world fell less, and in 12 months they were back to where they started. So that turned a whole generation of Kiwis off shares, pushed them into property, and we've been battling that for a whole generation ever since. But it is changing. I think it's 100% changing. And I started at Craig's in 2004. So I've been doing this for 22 years now. And back then, property, we're really battling really hard to get people to think about other investments. But in the last decade, and I've got to thank Sharesies for being a part of this, because you guys have, been in our corner trying to push the same barrow.
Yeah.
And it's 100% working. Young people, maybe because they can't afford houses, or maybe because they're more in tune what's happening around the world, they are very much more familiar with investing in financial assets, and the boomers too. I meet them every week, older folk who have just got sick of the property, and there's policy changes, and now there's interest deductibility, and the rates and the insurance eat into my yield, and I'm not making any money. And now that the capital gains have dried up, it's pretty hard to actually do well out of property. And meanwhile, you look at, the US or Japan or any share market, and, a lot of them have doubled in the last 3, 4, 5 years. So I'm seeing it across all demographics. And that doesn't mean I'm anti-property. I think it's a good time to buy a property, and it's an important part of a portfolio, real estate. But it's not the be-all and end-all anymore. So I reckon that tipping point is 100% been reached. KiwiSaver is a big part of it too. And I think it will continue to shift as you see, that generation that lived through 87, replaced by the younger generations who have got a different mindset. So I'm really optimistic for Kiwis and financial literacy and their openness to other assets.
That different mindset, is it more growth orientated? If you were to look at shareholder appetite, are we going more into growth stuff, or are we?
You mean growth stocks? You mean? Yeah, I think so. The New Zealand share market traditionally has been sort of the high income, the high yield market. Like, you buy New Zealand shares if you want a high income. Always had the real estate companies, always had the utilities, the electricity companies. And because of imputation credits, companies are incentivized to return capital via dividends. It's a really tax efficient way to give money back. Whereas in the US, it's not tax efficient, so you do a buyback, you don't pay a dividend. So if you want income, you buy New Zealand shares. If you want, capital growth, you go offshore. And, the younger generation and the older generation has pivoted to be more sort of growth focused. Although I think that's partly just education and understanding. And, we're in an age now where everyone understands sort of some of these global products. We're not as insular. The other big change I've seen in my time in the industry is, back when I started, we used to have to really battle to get people to go international in their share investments. People they'd see it as a bridge too far. It's higher risk to go to the US or somewhere, and they want to hunker down in New Zealand. It's like, actually, it's not. You're all invested in this tiny little country on a major fault line with one product that it sells to one customer. We're actually the risk. But these days, it's everyone naturally sort of is drawn to the United States or other parts of the world. And again, I think that's healthy as well. Yeah,
it is. What about those alternative assets? Crypto has been up and down. I see last year it didn't do so well, but it's such a volatile asset. It's probably that people need to think differently. If they're older and they've had a more traditional portfolio with, say, shares, bonds, property, but they're dipping their toe in the water, and we've definitely got quite a lot of those on Sharesies, having launched crypto last year. They probably need to think about it differently, would you say, or how would you describe how to go about it?
Yeah, I think that whole space is really interesting, alternative assets, and ask 3 different people, you get 3 different answers of what is an alternative asset. But anything that's not shares or bonds or property is basically alternative. So it's commodities, it's private businesses, it's private credit, it's infrastructure, it's gold, and it's crypto. And I think alternative assets is something you've got to have these days. We do a lot in the sort of private credit, private equity, because there's lots of opportunities there. Crypto, I don't think it is a must own, but it is mainstream these days. We don't call it cryptocurrency anymore because it's not a currency; it's an asset. So it is part of the mainstream, and it is an investable option. So while I've got a little bit of Bitcoin, call it 1%, maybe 1.5% of my portfolio. So that's kind of the level that I think is appropriate. Any more than that, and you got to know what you're doing, and I don't understand it as much as some, but I think it's just buyer beware. Even since 2018, which is sort of 8 years ago, crypto's been cut in half 4 times. 4 different times it's fallen more than 50%, and then I think another 3 times it's fallen 30%. So, just be up for the roller coaster. You can't just sort of buy it, and it's not a get rich quick scheme. So if you want it there as a strategic allocation, that's fine, each to their own, but you've just got to be aware that you might face some pretty serious. You think shares are volatile, crypto's another kettle of fish.
Jarrod, just getting back to our economy, some of the things that have been on my mind is like the dollar. The Kiwi has been, in the doldrums, if you like, against the greenback, obviously, but even against the Aussie. Do you see that coming back in 2026? I know it's good for exporters, but for the rest of us, wanting to do things overseas or whatever it might be, it's quite hard.
Yeah, no, we do. And we've underperformed because we've underperformed.
Yeah. Right?
We need to take a good look at ourselves and go, why was the RBNZ so heavy-handed, up, down, sideways, compared to, say, the RBA, which was a lot lighter touch, or other parts of the world? Why did we have such a bad recession and others didn't? So it's been reflected in the currency. So, the Kiwi is just that, right? It is Kiwi versus dollar. And the dollar, despite a lot of what Trump's tried to do or talked about wanting to do, it hasn't fallen off a cliff.
No.
As far as I'm concerned, the US dollar is still the global reserve currency, and it will be so long as the US has got the greatest military on the planet. So that whole de-dollarization has played out a little bit into crypto and a little bit here. And we'll diversify out of dollars. Yeah, but they haven't dumped dollars.
They've talked about it,
They've talked. And we've heard these bond market vigilantes for 30-odd years. US dollar's still king at this point in history. And I think it will be for the rest of my life, right? Just out there. So yes, we've gone down against the big dollar, which is helpful for our exporters, and that's great for that export part of the story. But when you're importing something from the United States, it's costing you more. So we've seen a little bit of an inflation pulse, if you like, on the weaker Kiwi, and it shows up in things like petrol prices and the like. Against the Aussie, we've underperformed, even further. And that to me is even more important because a lot of what we manufacture here goes to Australia. So that's actually quite an important cross for us. Very, very large trading partner of ours, great friend, ally, and that weaker not only helps tourism, but it helps that whole export story. So it's been good, but we do think the Kiwi dollar recovers, and we do think the Kiwi Aussie recovers this year, just because we've finally got interest rates at a level that matter, and we're going to see better growth here relative to the others. So we're gonna pick ourselves up off the ground. Kiwi, 60s, yes. Will it go as high as 63? That's our forecast. That's my forecast for the end of the year, which means it could be 65 and higher, but in that upward stream rather than trading down like we were saying pretty much all of last year.
So 2026, we've got an election. Both of you, I'd like to quite know what you're thinking. I know, Mark, you've already said that you think National will get back in again. They'll scrape in. Just thinking about what does that mean for our economy and this recovery?
Yeah, I do think they'll scrape back in. I think, if there was an election today, it'd be pretty tight. National's not doing super well in the polls, but economic recoveries do tend to be supportive for the incumbents. So if the view that Jarrod and I both share, that things will be a lot better by September, October, November, then they should be in a stronger position. I still think it'll be pretty close. For investors, my advice would be don't sort of get too hung up on what's happening in politics. There's always something going on, always a policy change. Focus on, profits over politics. Focus on what's happening with businesses, with the economy. Yeah, we've got to maybe fine-tune our strategy depending on winners and losers at a sector level. But generally, when you look back through history, good businesses will still perform well regardless of who is in power. And I think that, that's a message that, goes further afield too. We've got the midterms in the US, so it's not just here in New Zealand. We've got big political stuff going. But look, if you'd chosen to sell everything and sit on the sidelines because Trump got in, either the first time or the second time, whether you like the guy or not, whether you agree with some of the policies or the approach, you would have left a lot of money on the table. So, just don't get too hung up on what's happening in politics.
Jarrod?
I completely agree. Absolutely agree. I think, we've got a lot of sensitivity coming into this election, funnily enough. A lot of investors, a lot of clients of ours are asking, what's going to happen? And I wonder whether they'll still be asking if the economy's growing at 3%. If inflation's contained, if the stock market's up 10%, I think that worry will subside somewhat. People hurt more in bad times, and they obviously try to vote more radically in bad times when things are going well. And I think things will be going well into the election. People will be a lot more settled and just breeze through it. It's not like the elections we got in the 80s and 90s, which were quite violent. These are, a lot more centralist parties. We're not as radical. So from my point of view, I think we will roll right through it.
Okay, last question, Jarrod and Mark. Let's think about, in 60 seconds or less, what is the most important thing or things that investors need to know this year, 2026, Jarrod?
We're growing. Finally, we're growing. So look to this year with a bit more optimism and look to get involved. Actually look to do some investing, actually look to expand your business. I think now is the time. Policy settings are about right. So I think this is it. This is a good recovery.
Mark?
And me, I just think the most important message is keep your eye on the long game, especially when we're talking about asset classes like shares. It's a long-term asset, so remember that. Don't get hung up on some of the noise, some of the worries and the here and now. US shares the last 30 years done 10% per annum. Over those 3 decades, you've seen, 3 recessions. You've had 2 times where the market fell 50%. You've had a pandemic. You've had a housing crisis. You've had numerous sort of wars or geopolitical conflicts. You've had a whole bunch of times when the market fell 10 or 20% and recovered. But, it still did well over that period. So just get on with things. If you want to sit on the sidelines, I can give you 10 reasons to be worried and sit on the sidelines at any point in time, whether it's good times or bad times. But I think people do well when they just focus on that longer term.
Cool. Look, thanks, guys, for the long chat. We could have probably kept going forever here. So thanks, Jarrod, and thanks, Mark, for joining us today.
Much appreciated. Thanks for having us.
Yeah, thank you.
And thank you for tuning in. You can watch Shared Lunch on YouTube or follow us on your favourite podcast app. Leave us a rating and let us know what you'd like to hear next. Mā te wā.